Hey everyone, happy Thursday, August 3rd. It's about 11:30 on the West Coast and time for another market update. Once again, another busy week. Starting off last Friday, we got the Fed's favorite form of inflation, the PCE inflation for June, and they came in good. It was only up 0.2% as expected, month over month. The year over year is down to 3% from the peak of 7%, and the core came down from 4.6 to 4.2. We know the core is what the Fed's really paying close attention to, what they believe is the most important part of it. And looking at a graph, as like I said, you can see the headline has come down a nice trajectory. The core has been a little bit slower to turn. We know this is shelter cost lagging and a couple other things lagging, but it looks like it's started on that downward trend. So hopefully keeps coming down and gets towards closer to the Fed's inflation target of 2%, which is debatable if inflation needs to be there, but that's what they've outlined as where it needs to get. The next thing we got, and of course we can't just have what we expect to get, but we got something out of the ordinary a couple days ago, or unexpected, which was the Fitch credit rating downgraded the United States from AAA to AA plus. So still a really good rating, but me being in the mortgage industry, we look at people's credit. Basically, when things get, when people's credit goes down, it's not a good thing. And basically what they're saying is that there is too much debt. A lack of governance. You're saying the debt ceiling was not a good thing, that whole debt ceiling drama. So that's coming back to bite us once again. But bonds have really reacted negatively to this Fitch credit rating downgrade. So once again, curveball the markets threw to us, all stemming from that debt ceiling about basically the United States spending way too much money and not making enough money, just like everybody else. We're going into large amounts of debt every day. So the next thing we got, so this week is Jobs Week. Jobs Week is always important, and it's really important because the Fed seems to be really, targeting that, how jobs are doing and how strong the labor market is. Politicians as well are talking about it instead of the inflation stuff. Which is their mandate as well. The Fed has to concentrate on inflation and jobs, and right now they're concentrating on how, even though inflation's going down, they're acting very confident, knowing that the jobs market is staying really strong. So the job openings report for June, they came in slightly lower than expected. So good, good if you're rooting for that kind of stuff. So a little bit less job openings, down to its lowest level since April 2021. And then ADP came out a couple days ago, another blowout one. Almost double the estimate. It was estimated about 190,000 jobs created. It came in at 324,000 jobs created. They made a negative revision in June. Remember, June was a huge number too. June was, estimated about 190 and came in at 500 almost. They made a negative revision to that, which again is just always a little weird to me. We get these negative reactions to these numbers when they come out, and then a month later they make negative revisions, and really nothing positive happens at that point. And then the BLS, which we get tomorrow for June, was 149,000 for June. So big discrepancy. So it'll be interesting to see what numbers we get for July for BLS tomorrow. And then so what they're saying is small businesses is where the huge gain was. And leisure and hospitality, they still had 232 in June, 201 in July. BLS for June had 21K jobs created. So basically 1/11th of what ADP had. So there's a big disconnect. Everybody would just like data we can rely on. We don't want to think that the data is unreliable and it's wishy-washy. And with these reports being so out of sync, it's a little hard to trust. So it's a little hard to know what the BLS for tomorrow will come out with these ADP numbers so out of whack. And then following up on that today is initial job claims. Initial jobs claims came in as expected, 227. So still pretty strong though. Employers are working hard to keep employees with the job market so strong. So we haven't really seen much elevation here. There have been a lot of big number layoffs lately. Yellow Trucking, I believe, laid off 30,000 people earlier this week. Things like that. CVS, I think 5,000. So it'll be interesting to see when those start hitting these numbers. But for right now, the jobless claims have stayed leveled off even lower than the 240 they were at for a while, and so that is not good for mortgage rate, but it's good for employment and stuff. Purchase apps down 3%, 26% year over year. Not good for mortgage apps right now. Miscellaneous, we got CoreLogic. So CoreLogic came in again with their appreciation numbers for June at 0.5%. So again, across the board, every one of these different metrics is showing home prices across the country appreciating at an accelerating pace. So 2023 pace for CoreLogic now is up to 10%. Zillow's at 10%. Those are big numbers. If you did not buy a home and you missed out on 10%, a $500,000 purchase, that's $50,000 in equity you would have gained, nationwide. So, never everybody always wants to wait till prices come down, but obviously prices are not coming down anytime soon, and prices have actually turned higher. So if anything, it's more expensive for you now, especially with rates a little higher. And then apartment list. Oh, real quick, apartment list came in at, I think year over year now, they're at a negative 0.7% for rent. So again, going back to that June PCE, shelter inflation is still showing high on these reports, but now, nationwide, all these rental places are showing it, a lot lower than these other inflation reports. So that's good to know. Just know that it's built in, that we know that's coming in the future, that should start showing up on these inflation reports. But it's also good for renters to see that the rent prices are coming down. Where does that leave us? Average 30-year conventional is up to 7.2% from 7.09. Not the highest. The highest was last November, 7.37, I believe. But I think that might be close to the highest year to date for 2023. So not good news. We're in these 7 levels for a while. This Fitch credit rating thing really hurt us this week. And again, the jobs market's staying really strong, and everybody knows that the Fed, that's what they seem to be, like I said, focused in on. So where do we go from there? We got a lot of important dates coming up. So I wanted to, I showed a couple more here because the Fed meeting, their next meeting is not till September 20th. And right now, they're saying about an 85% chance they don't hike, which is what we'd want. So before they have their next meeting, we got the BLS jobs report tomorrow, which is really important. And then we got another one beginning of September. We got CPI in August, and then one in September, and then another PCE report at the end of August. So all that data will be out there, along with all these weekly unemployment data and all that kind of data will be out before the Fed makes their next decision. So it seemed like they were willing to pause. It seemed like they're willing to, look at the data, and they almost like they want the data to come out where they can pause and give them an excuse. So hopefully that's what happens. Hopefully these reports, starting with the BLS jobs report tomorrow, shows some weakening in the labor department. Not too much. Again, we don't want to see a bunch of people lose their jobs and economy go into a downturn and stuff. But, that kind of stuff is what we'll kind of need for the Fed to pause and then eventually to pivot. So, where does that leave us? Again, it's tough out there. Rates are a little bit higher than we expected at this point, and they continue to look like they're going to be, elevated at least, where we'd want them for a while. So everybody's got to hang in there. Again, it's all about payment and affordability. And if you can afford the payment now, you probably should jump in there because, as you can see, home prices keep going up and you're wasting on equity opportunities. So if you have any questions about this or anything else, don't hesitate to reach out, and I'd be more than happy to help. Have a great week, everybody.